Okay, let's jump right into this explainer. Look, we are witnessing a massive, fundamental shift in the market right now. Think back to between 2023 and 2025. Literally, if a company even whispered the letters A and I on an earnings call, their stock price just skyrocketed. I mean, the market gave everyone the benefit of the doubt, right? But come April 2026, that window slammed completely shut. Today, we're going to unpack exactly how the first quarter of 2026 rewrote the entire rulebook for how Wall Street values enterprise AI investments. We're talking about a hard transition from this era of, honestly, blind optimism straight into an era of strict, auditable accountability. Moving to Section 1, the $145 billion question, we're starting right off with the dramatic catalyst that triggered this massive market shift, away from all that blind optimism. And, it all went down on April 29th. Picture this. An analyst on Meta's Q1 2026 earnings call asks Mark Zuckerberg what is, let's be honest, a totally reasonable question. What are the signs of return on the company's AI investment? Now, keep in mind, Meta is projecting to spend up to $145 billion with a B on AI infrastructure in 2026 alone. That is literally more than they spent in 2024 and 2025 combined. And Zuckerberg's response? Just look at this quote. He deflected. He literally called it a very technical question and basically just offered this vague assurance about having a sense of the shape of things. Well, for $145 billion, you'd probably want a bit more than just a sense of the shape, right? The result was brutal. Meta's stock dropped 6% in after-hours trading overnight. And the craziest part? This happened despite Meta posting $56.3 billion in revenue, up 33% year over year, and profit growth of 61%. By any historical standard, that is an absolute blowout, triumphal quarter. But by the new standard imposed by this AI capital expenditure cycle, that single vague deflection cost them dearly. And honestly, this brilliantly illustrates our new reality. Just compare Meta's disastrous market reaction with Alphabet on that exact same day. Sundar Pichai over at Google didn't talk about the shape of things. No, he delivered specific, auditable, hard numbers. He laid it out. Cloud revenue grew 63%, hitting over $20 billion. AI products built on Gemini were up nearly 800%. And new customer acquisition, it doubled. Unsurprisingly, Alphabet stock went up. So, the takeaway here is crystal clear. Investors are actively, aggressively punishing aspirational, venture capital-style storytelling from public companies. Instead, they're immediately rewarding the guys who can deliver specific, quantitative data. The market is absolutely pricing in the quality of your disclosure language right now. Okay, Section 2, the 90% reality check. Let's pull back the curtain a bit and look at the macro data to understand exactly why the market's patience suddenly, poof, vanished in April. So here's the crucial point. Almost everyone is deferring the hard numbers. Goldman Sachs actually ran this massive screen on S&P 500 earnings calls. And what they found is kind of staggering. 90% of companies discussing AI are using purely qualitative language. You know the buzzwords, transformative, reimagining, next generation, that sort of thing. Only 10% are actually using quantitative language, meaning actual dollar values or, say, headcount avoided. And why is that? Well, frankly, it's because the actual return on investment work just isn't legible on their financial statements yet. Sure, productivity gains might be happening over in some isolated team, but they definitely aren't rolling up cleanly to the consolidated income statement. And unfortunately, this issue is compounding. There's an NBR survey of 6,000 executives across 4 different countries that exposes an even more uncomfortable truth. Ready for this? 90% of them reported zero AI productivity impact over 3 years. Not 3 months, guys. 3 whole years. And the underlying constraint here, which Deloitte CTO pointed out, is that companies are allocating a whopping 93% of their AI budgets strictly to the technology, and a measly 7% to the actual people who are expected to use it. Basically, companies are spending massive capital on all this shiny new infrastructure without actually figuring out how to integrate it into real human workflows. Yet, ironically enough, according to a BCG survey, 80% of CEOs report being more optimistic about AI ROI today than they were just a year ago. It's wild. It highlights this massive, glaring disconnect between the budget owners sitting at the top making the decisions and the actual measurable financial results happening down on the ground. The stock price reactions we saw in Q1 absolutely prove that the market is finally believing the 90% reality check over the 80% executive optimism. Moving right along to Section 3, the AI disclosure spectrum. Let's examine how the financial sector is consciously choosing to handle this intense pressure from Wall Street. Because financial services is actually the sector where AI disclosure has gone the furthest. Now, when you look closely at how these top banks are reporting, it becomes super clear that the lack of hard data isn't some technical limitation for these massive institutions. No, it is a highly strategic choice. Just look at Bank of America. They disclose pure usage metrics like, hey, we had 3 billion interactions with our Erica AI, but zero financial impact. Then you have Goldman Sachs. They report internal productivity ratios, saying things like they're seeing 3 to 4 times coding gains, but they flat out refuse to attach a public dollar figure to it. And Danske Bank? They just bundle their AI gains in with general technology improvements and inflation absorption, making it utterly impossible for an investor to isolate the actual AI contribution. They are all playing it incredibly safe, because the moment you publish a hard number, well, that number becomes the permanent baseline you are measured against. All right, Section 4. The new gold standard. Because despite all that, there is one company out there setting the exact standard that the rest of the market will now be judged against. They are flat out refusing to play it safe. JP Morgan proved that if you step up and provide real numbers, you get rewarded. They established this robust 5-element framework. 1, they clearly stated their overall $19.8 billion tech budget. 2, they specified the $1.2 billion incremental spend specifically for AI. 3, they mapped out over 400 production use cases. And 4, this is the crucial one, they provided a public projection of $1.5 to $2 billion in annual AI-generated business value, plus year-over-year tracking. This is highly unusual transparency for the banking sector. But JP Morgan proved that if you provide these 5 auditable elements, you build serious trust. This right here, this is the literal blueprint for corporate survival going forward. Because make no mistake, guys, we have seen this exact movie before. We all remember how the dot-com boom ended, right? Just look at the telecom build-out of the late 90s. We went from early enthusiasm in 96 to massive capital expenditure, followed by a period of really qualitative, vague disclosures. And then bam! In the year 2000, we hit the exact same inflection point we are hitting right now, the show me the cash flow phase. Companies that had infrastructure serving legible revenue like Cisco, they survived. Companies built purely on leading the next era rhetoric, they did not. The current AI cycle has officially hit its show me the cash flow inflection point. Which brings us to our final section, Section 5, the survival playbook. So how do we actually successfully navigate this massive shift before the Q2 earnings calls roll around? Well, we need a game plan based on what Q1 just taught us. First up, for the CFOs out there listening, you have a really crucial decision to make by mid-June. The market is actively discounting qualitative AI language right now, so if you are still using vague, aspirational buzzwords by Q2 2026, you are actively accepting a structural discount on your valuation, period. You need to adopt the JP Morgan 5-element standard. Look, even if you don't publish the numbers next quarter, you absolutely must start building the workflow telemetry and productivity baselines required to get those numbers immediately. Now, investors, you need to ruthlessly screen your portfolios right now. Pull the Q1 2026 transcripts for your holdings. Run that Goldman Sachs 90% screen we talked about. Actually count the quantitative metrics versus the qualitative fluff. If a company's AI language is over 50% quantitative, great. They're positioned well for this inflection. But if they are below 20% quantitative, flag them immediately as high risk. You have got to calculate your forward exposure to this qualitative language discount before it burns you. And finally, for the AI vendors tuning in today, your product marketing has got to pivot immediately. Your customers are about to face intense scrutiny from their boards. The pitch that wins in 2026 is no longer about being transformational. Throw that out. It's about being auditable. Honestly, if your tool doesn't provide the workflow telemetry for a CFO to confidently publish a JP Morgan-style disclosure, you're heading straight into a brutal race-to-the-bottom price war based on commodity capabilities. So I'll leave you with this final thought to really chew on. The AI capital expenditure cycle is no longer a free ride. A good narrative is no longer enough to boost your stock price. As we enter the back half of 2026, you really have to ask yourself, which side of the disclosure gap are you standing on? Are you paying for and actually proving auditable productivity? Or when the market inevitably asks you to show the cash flow, are you just going to tell them it's a very technical question? Thank you so much for diving into this explainer with me. Keep analyzing, keep expecting hard data, and I'll catch you next time.